Market Catalyst, I'm Julie Hyman. We're 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First up, we'll push ahead to a big week for markets with jobs and inflation data on deck. Plus, we'll bring you the big takeaways from Super Bowl commercials and talk investing in women's sports with former NFL player and executive Jason Wright. And we'll have more on the state of the insurance industry after a $100 billion sell-off. We're talking health insurance, sparked by new proposals from the Trump administration. All that and more coming up on Market Catalyst. But let's take a look at what's going on first in the markets here. We do have a mixed picture. Now, the futures had been indicating a slightly lower open, and that is still the case for the Dow, which is down more than 150 points, and the S&P 500, which is slightly changed to the downside. The NASDAQ seeing a little wee bit of a bounce today. And if we look at the NASDAQ 100, we can see exactly where that bounce is, but that's year to date. So let's take a look at the intraday action here. So the bounce is happening, but it is not a very widespread one, to be sure. So NVIDIA seeing a comeback of about 3%, Microsoft up a little bit, but Amazon, after it was one of the outliers declining on Friday, is still down this morning, and so are Apple, Alphabet, and Meta. So really, not a lot of uniformity or unanimity with this rebound that we are seeing here this morning. If you take a look at the sectors in the S&P 500 here this morning, you've got consumer discretionary under pressure. Amazon's in that one, by the way. Healthcare under pressure. Tech, though, is indeed rebounding. Energy, which is the best performing group this year, is also seeing a little bit of a bounce. If you go into software, which is really where a lot of that selling, of course, last week was concentrated, you are seeing a more substantial bounce back. Oracle, which is getting a positive mention over at D.A. Davidson, our friend Gil Luria this morning. Palantir is bouncing as well. Microsoft, as I mentioned before, but even here, the likes of ServiceNow is still lower, or an Adobe is still under pressure. So that's something we're going to continue to watch. And then we got a bounce here? Nope, we sure don't. We are seeing crypto prices still under some pressure here this morning and still below 70,000, but up off the lows where we saw them last week. Now, a sharp rebound after last week's sell-off may be causing investors more anxiety than relief. Despite the Dow's surge past 50,000, some market participants are still grappling with questions around AI spending, the future of software, and more. And this week, investors will focus on the January jobs report and the latest read on inflation coming on Wednesday and Friday, respectively. And joining us now, Chris Watling, Longview Economics Global Economist and Chief Market Strategist. Chris, thanks so much for being here. So it was a strange week, right, with that sort of volatility that we saw. Then we saw a very sharp bounce back on Friday. But where does that leave us now, right, given that, volatility? Doesn't feel like everything's just magically okay?
Yeah, it was extraordinary, wasn't it? I mean, the software stocks sold off so hard in the past 2 weeks until Thursday, and then bounced hard on Friday. They were deeply oversold on Thursday. I mean, really deeply oversold. So I don't think you want to read too much into one day's move when you're deeply oversold. I think really when you stand back from it and you look at the S&P 500 and the NASDAQ, they've basically gone sideways since October. They've been range-bound now for 3, 4, 5 months. And what's interesting is within that sideways move, they've been rotating a lot. And as you mentioned, the Dow at 50,000, cyclicals are taking up the running. The Mag 7 under pressure, as you touched on. So they're underperforming now. And of course, everyone was super long the Mag 7 into October last year. Everyone's super excited about AI. You remember September, things were surging like Oracle and TSMC and all that sort of stuff. And now I think we're thinking, well, hold on, there's a cyclical recovery coming. I need a bit of classic cyclical exposure, as well as some exposure to all that AI capex that creates, supply bottlenecks somewhere. Down the chain, the guys down the food chain who make, the nuts and bolts and the old economy stuff that's important for data centers and so on. So I think we're seeing that. I think the market's rotating within a sideways range, and more cyclical parts are taking up the running. And the real question is, what's happened to tech? Is it off, or is it going to come back? I think that's really the big question you have to answer.
What's your answer to that question?
I thought I think it'll come back. The market's clearly getting nervous, though, about people that are spending too much on capex that don't have the cash flow. And Amazon, I think, was a great example of that last week. So I think the market's becoming more discerning, but I think the market in aggregate is still going to go up because, I mean, it looks like the estimates are AI capex spend will add about 1.5% to GDP growth in 2026. That's a big number. That's a really big number, and that has a lot of multiplier effects. So, yeah, I mean, I'm not a stock guy, single stock guy, so
right.
I don't pick single stocks. I would buy software for a bounce. I wouldn't know whether you should keep buying it. Maybe Microsoft, I don't know.
Well, it's interesting that, that you're not a single stock guy. We talked to Mohammed El-Arian earlier in the show, who I don't think of as a single stock guy, but even he is saying now is the time to be selective. And he likes Alphabet, for example, which was an interesting conversation to have. But from what you're saying, it sounds like I hear a lot of people right now saying you do need to be more selective and look at the individual stocks. But if what you're saying is correct, is you got the capex thing, you got everybody in the cyclical area maybe benefiting from GDP growth, maybe also benefiting from AI because they're supplying stuff for it, that you could just buy the S&P 500.
Yeah.
And do all right.
Absolutely. Or in fact, you could buy the mid-caps or you could buy the Dow or something like that that's a little bit more cyclical than just the S&P 500. But I'd have exposure to both. I think the market looks good for this year. I mean, dare I say it could be a Goldilocks year.
Uh-oh, don't use that word.
Never use that word. It's a kiss of death. But no, it does look like it could well be. We've got disinflation. We've got Kevin Walsh coming, who's more inclined to cut rates than the rest of them, or at least as some of the rest of them. And you've got growth that looks good. I mean, what isn't to like about that? It's a pretty good combo.
What is the risk, though? Is there a too cold risk or I mean, it seems like there would be more of a too cold risk than a too hot risk.
Well, it's definitely not the too hot risk at the moment. Yeah. You're right. It could be the too cold risk. There's always geopolitical risk. Creates volatility, but that tends to spike and die down and disappear, as we saw earlier this year. We're all obsessed with Venezuela for 3 or 4 minutes. So yeah, there are definitely risks, but and inflation being stickier than I think is a risk. But the reality is, when you really stand back from it, it looks pretty good.
What do you think the jobs report's going to show on Wednesday?
Well, I think the labour market's stabilising, but it's early days. It's
stabilizing at what kind of, what does that mean in this environment?
Well, the problem with that statement is, what does that mean and what's normal these days?
Right, what is stable, creation? Yeah.
So I think we're probably stabilizing in the low 10-20s per month payrolls trend. And the labour market growth is probably 50 or 60 a month. There's a big debate about that in markets. Some say 40, some say 100. Who knows? It's very difficult to be confident. The point is, it's below where it should be,
right?
Whatever the estimate is.
Right.
So another reason for disinflation and rate cuts.
Well, I keep thinking about what Jay Powell said at the last press conference, where he was asked about the labor market versus GDP. And he said, usually one of those is wrong and one of those is right. And he seemed to indicate that the labor numbers tend to be a little more accurate than the GDP numbers.
Right.
So he seemed to be tipping a little more on the side of maybe labor market isn't doing so great.
Yeah, that's right. And also what he said, which inclines him to cut rates. What he also said was, which I didn't think get a lot of attention. He said, actually, if you look at inflation and you strip out tariffs, which look like they're one-off, core's just above 2. And services is disinflationary in all sectors, which I thought was remarkably sort of a disinflationary type comment. Mm-hmm. So I think reading between the lines, they're all inclined to cut more. And the evidence that the labour market is sticky wage inflation, that's all dissipating. And actually, it's the bias is to the labour market's too weak. We need cuts.
How many cuts do you think we're going to get this year? I was looking at Polymarket, and it looks like the kind of split between 2 and 3 cuts this year.
That's right. Yeah, I think the Fed fund futures have got 59 basis points or something like that.
Yeah, which one are you watching now? Are you watching Polymarket or are you watching the Fed funds futures? We always used to quote the Fed funds futures, and now we're looking at the betting market.
I'm not cool enough to watch Polymarket. But I would watch Fed fund. I'm sure that I don't know how much money bets in Polymarket on interest rate cuts,
right.
But I reckon it's probably more in the bond market and the Fed funds futures and on the CME and so on. So yeah, I think we got 2 and a bit cuts. I wouldn't be surprised if we had 3. I think 4 is possible. It depends on where we're at when Walsh turns up, assuming he gets confirmed, which I think is pretty likely. So yeah, I think you could, if you like betting on rate cuts, there's a trade to be had.
I want to ask about metals too, because I know you've written a lot about that, and you kind of warned that maybe the metals were getting a little toppy before they tumbled.
Yeah.
I thought it was really interesting in your latest note when you talk about sort of, you have to differentiate your time period, your time horizon when talking about what the metals are going to do. For the longer term, you say this is a good thing to hold.
Yeah.
But in the short and midterm, things could be a little rocky.
Yeah, I mean, I would longer term. I actually wouldn't hold it here because I think it's worth buying on weakness.
Got it.
But
But you wouldn't enter at the levels where it is right now.
Absolutely not. I mean, if there's ever been a price bubble that looks like a price bubble, it's definitely silver and it's probably gold.
Still.
Well, in terms of the inflation up until 10 days ago.
Got it.
And now I think we're the other side of that bubble. We're unwinding it. So generally, the rule of thumb is take silver as an easy one. It goes back to the price where the acceleration phase started. Now for silver, that was about, you could argue it's $30, you could argue it's $50. But whichever you argue, it's a heck of a long way down from here. So I would be looking to sell silver as a short-term investor or a medium-term. And I'd be looking to buy silver and gold on significant weakness.
So where do you think the bottom will be for either of those? Well, you were just talking about silver. What about
gold? I'd need to check my data, but it wouldn't surprise me if it was something like 3.5-ish. Best guess. You need to check what the trend is, and to be honest, I don't have it in my head. But it's a long way down from here. Let's put it that way. But yeah, in the very long term, they're debasement trades, as everyone's been talking about.
Right.
I mean, they're plays on an international monetary system that's unanchored, that's a fiat currency system that creates money all the time. But you never want to own them when you've got a cyclical recovery, because ultimately cyclical recovery attracts money elsewhere into the cyclical areas of the market. And they're not good when the economy is recovering, because that means, in the end, 10-year bond yields are going to be higher, etc.
Right. What do you make of, on this front, of the Bloomberg report this morning that China is making noises about taking a look at Treasury holdings?
Right.
Do you think we're going to see, I mean, who knows if it's political versus real, but do you think we're going to see more of that?
Well, I'm sure we will. I haven't read the report, but what I would say is, I mean, this story comes up every 6 months. I don't think markets are about who's buying and selling, so to speak. They are on one level, but they're really about where's the fundamentals say yields should be. But US 10-year bond yields should be tracking up over this year anyway. So if China's a seller, okay, fine, but there'll be other buyers who'll come into the mix. And yes, probably some of it's political, and we've seen them buying a lot of gold, and we've seen them diversifying away from US Treasuries. And actually, they're not nearly as big a holder as they were 2 or 3 years ago.
Right.
So I wouldn't worry too much about it, personally.
Okay. Chris, thanks for coming in. It was good to see you. Appreciate it. And by the way, you can find more Fed predictions and other bets by going to the Yahoo Finance Predictions Markets Hub, powered by Polymarket. Coming up, the big game may be over, but the business of sports is busier than ever. We're talking to a former NFL player and president about why he sees women's sports as a massive financial opportunity. Plus, from AI to potato chips, the biggest Super Bowl ads from game night, and what that tells us about what corporate America is thinking right now. Stay tuned. You're watching Market Catalysts. Ariel Investments' Project Level announced the successful completion of its first funding round with a total of $250 million in committed capital. In the announcement, co-CEO Melody Hobson writes, quote, "Women's sports are no longer an emerging story. Their time has come." Jason Wright is Ariel Investments' managing partner and head of investments at that project level. He's also the former president of the Washington Commanders. It's great to have you here, Jason. I do obviously want to get into Project Level and what you guys are investing in. But it's the morning after the Super Bowl, so we got to start there. Right. You're a former player. You're former president of the Commanders. Everybody keeps saying that game was boring. I'm curious to get your take on it.
If you are a true football fan, it was a great game. There's a mantra that back in my era where we said defense wins championships. In recent years, people have thrown that out the window. I think yesterday was a reminder that defense does indeed win championships.
All right, for true football fans, I thought it was also interesting that a running back was MVP, for the first time in 28 years? And you were a running back. Kenneth Walker III is the guy who got that nod last night. So I guess also as a real football fan, that must have been a fun moment.
Oh, it's sweet for us as former running backs in an era where people have said running backs have become obsolete. That young man played incredibly well and showed what it means to make the position prominent again. So we're all happy to see that. It was a great game. I really enjoyed it.
I'm curious to talk a little bit more about the business of the NFL too, because there have been some reports from ESPN that the Seahawks are now going to be up for sale after the Super Bowl, and that could fetch the highest valuation ever for a team. I'm sure this is something you're watching closely. I mean, do you think would that be your expectation as well?
Unclear what's happening with the Seahawks. It's a complicated piece because of the estate and the owner of the team, and being able to have it owned directly by an individual versus an estate according to NFL rules. There's a bunch of stuff around it. Either way, we're in an era where institutional investment has come into sports, and sports have professionalized in response to that. And interestingly, as a segue to women's sports, that's why women's sports is having a massive commercial moment on the heels of Caitlin Clark, where there's been great talent in the past. Now there are real solid business fundamentals behind it because sports has professionalized and there's an ecosystem to handle it. So whether the Seahawks sell or not, there will be other teams that sell in more rapid succession in the coming years because there is more interested capital and it's a true asset class.
So I'm curious about that, Jason, whether we're talking about women's sports or whether we're talking about the NFL and men's sports, the institutionalization. What are the sort of advantages and disadvantages? And on the disadvantage side, given that you're in the women's sports investing side, what are you guys working to try to avoid that might be some of the pitfalls of that institutional investment?
Yes, I think primarily it has been a positive thing. I'll give an example. When I went to the Commanders, it was still run more mom and pop. Run like a local family-run business. And we had to bring in the right talent. We had to develop a proper revenue strategy, start to focus on EBITDA, really have business principles around it, not just to make money for the owners, but also to have a sustainable business that treats the players well and has proper facilities, et cetera. And that approach is what's needed in women's sports at this moment, where the talent on the field, court, and pitch has been strong for decades. We all have women's sports heroes. It never had the ecosystem built around it to make sure that those women's salaries could go up, that there was profit margin to provide that on a sustainable basis, and that you were building fans in a sustainable way. And so we aim to come in at scale in women's sports, high enough in the cap table to draw on my operational experience turning around an NFL team where we grew revenue over 50%, expanded EBITDA 9x roughly, to really drive that sort of productivity in women's sports.
And where do you see the biggest opportunities in women's sports? I know you all are invested in volleyball. You're invested in the Denver women's soccer team. Where else do you think there is room for growth there?
We believe that the opportunity both for our LPs and for the whole ecosystem to strengthen and be great for 30 years is in every part of that ecosystem. The teams in the mature women's leagues, we plan to invest in those just how we have at Denver FC, or Denver Summit FC, where we sold 8,500 season tickets and over 40,000 tickets for our home opener, which is amazing. We also see it in the real estate and real estate related businesses that surround it. Unsexy things like janitorial and parking that have great cash profile to balance out the returns that come from a team. And also make sure that you have world-class guest experience at these facilities. Also the leagues that could be next in high participation women's sports like volleyball, softball, track and field, flag football, and some others. Youth sports, which many are structured like private equity roll-ups with great economics that create the fans and the talent for what's coming next, and the technology businesses that surround it and make the P&L more profitable or the players more healthy on the field, court, and pitch. We're investing in that whole ecosystem because it's best for our LPs. We get real private equity quality returns, and it's great for the athletes and the fans.
Jason, I'm also curious about the sort of player power on the women's side. We right now are watching the WNBA players union, the negotiations with the players union, and we've seen some quite contentious women's sports negotiations on that front. Do you think that the leagues are recognizing what they have, recognizing the worth of the players? Do you think that the players, sort of where does the power reside at this point?
Yeah, I'm actually very excited to see the challenging CBA negotiations going on in the WNBA, because to me, as a former NFLPA rep who was our representative for the Cardinals during the 2011 lockout, the owners of the players, it means that women's sports has hit the big time and that there is enough economic and financial potential to be having real negotiations around this. So I think people should be unafraid of contentious CBA negotiations. That's the only way that they're done. It just means that women's sports has truly arrived. And I can't speak for every single owner, but I know that the reason we are investing in women's sports and want to be invested in basketball and football, global football and soccer and flag football and all these sports, because we believe they can be profitable enough to see women's salaries exponentially increase. When we've modeled out looking at teams in the WNBA or the NWSL and others, we model in a multiples increase on salaries because we know that we can run businesses in a way that can provide that and think that the whole industry can sustain that.
Love to see it, Jason. Thank you so much. Appreciate it.
My pleasure.
One of the biggest themes of this year's Super Bowl ads was, of course, AI. Anthropic made its debut at the big game, the ad mocking OpenAI's decision to introduce ads on ChatGPT. And Amazon's ad showed actor Chris Hemsworth fearing that the new AI-powered Alexa might be out to get him, figuring all kinds of creative ways that Alexa might end him, in fact. And joining me now is Marcus Collins, University of Michigan Ross School of Business Marketing professor and author of For the Culture, The Power Behind What We Buy, What We Do, and Who We Want to Be. Marcus, it's great to see you to talk about this. Did you have a fave?
Of the many spots that I enjoyed, my absolute favorite had to be Levi's. I thought the Levi's spot was so spot on. I mean, it was on their home turf. It was in San Francisco at the Levi's Stadium, and they told a story that only Levi's could tell from the backside at that, right? It reminded me a lot of those Apple iPod plus iTunes spots where the dancing silhouettes with the iPods. This felt like that. It was like a silhouette where the brand was front and center, and the celebrity that's featured in the spot is sort of the vehicle by which those stories are told. It's just perfect.
And Marcus, as somebody who is so steeped in this stuff, like what's the formula for a winning Super Bowl ad? And if that was the epitome of it, how did it hit all those marks?
I got to tell you, when I used to make ads as an advertiser for Super Bowl, it's a completely different brief than it is today. The expectations are so much higher than it was just 5 years ago. There's so many new components to it where people see the ad before it airs the day of the game that adds these different complexities. There's so much to sort of to keep in mind. But at its core, a Super Bowl ad has to do three things. One, it has to impress, right? It has to feel like, wow, I've never seen this before. This is awesome. Two, it needs to get the story across about the brand, right? The brand can't get lost in the sauce. And three, people have to walk away with something sticking, some flag in their brain with regards to the brand. For Levi's, in this case, they did a really good job at that. One, unexpected. All you see is an ad full of butts. Not bad if you're a butt kind of person, but unexpected for sure. Secondly, the brand is front and center. The red tab there, which is iconic branded asset for Levi's right there. And then you walk away thinking that wow, the silhouette of Levi's looked pretty good. And you hear all these people from Woody at Toy Story to Bruce Springsteen, Faith by George Michael, all the way to Doechii, today contemporary originals. This brand is a part of this long, iconic history of pushing culture forward, which is what this brand is all about, progress.
So by those measures, how did the AI guys do? I mean, that Chris Hemsworth ad was definitely funny, right? And sort of taps into the concerns that people have. I thought it was interesting the Anthropic ad also taps into the sort of more fears and concerns that people have about this technology.
I was a fan of both, to your point. I thought that both spots did a good job of feeling like they were in the group chat with us, that they kind of knew the anxieties that we have about AI, the concerns that we have about AI, the things that annoy us about AI, not just the fact that they're going to be bringing ads to the platform, but also that sort of weird glitch where it sort of doesn't respond. And then it's like, hi, here to help you. Like it's just these things that feel so off that we talk about with our friends in our group chat. It felt like the brand was like, we hear you, we get you. And when advertising does that, it feels much more relevant. It feels like it's for us. The Alexa spot, it's all the fears that we have that AI is going to kill us. And this is like Terminator showing up, that we're inviting to our homes. For them to understand that and to do it in a way that felt tongue in cheek, but also like not too far from what we worry about, it really hit home, I thought.
I'm curious too what you thought of, we here at Yahoo Finance, we have been talking about the GLP-1 trend a lot, right? It's so in the zeitgeist. Do you think that Novo Nordisk rose to the occasion of it already being in the group chat?
I felt of the GLP-1 spots, the Serena Williams one really stuck the landing. I mean, we have a mental picture of Serena Williams, right? And when she was introduced as the spokesperson for the brand this summer, right, we saw Serena Williams. And we haven't really seen her, out and about, outside, as the kids say, since this spot. And when she says, like, this is Roe, this is Serena Williams on Roe, you go, whoa, this is a real thing, because her body seems transformed, but yet she still seems to be active and healthy. Like, that really stuck for me. I made a list of spots that kind of stuck after I saw them, that, after the dopamine wears off, like what really sticks around. That ad really did it for me from a GLP-1 perspective.
And actually, Marcus, I have to say, my own, and not being an advertising expert, to me, the most successful ad of the whole night was not an ad at all. And that was that halftime show and what it said for Puerto Rico and for Bad Bunny, but especially for Puerto Rico. I just felt like it was a real successful portray. I mean, that set, the performance was just kind of incredible.
That performance was pure joy. It just felt like joy. And there was a clear line demarcation of everything before the performance and everything afterwards. I mean, I feel bad for any advertiser who had to run their spot after the Bad Bunny performance, because it was unbelievable. And really, what Bad Bunny has done, much like Kendrick Lamar the year beforehand, it told a robust story. It was a performance. It wasn't just a show. It was a full-on experience. It had all these hidden Easter eggs inside of it that if you're close to the culture, then you feel like, oh man, I see you. And being able to see that, that's really when marketing is at its best. That's really when cultural production is at its best, that you feel close to it. When everyone's watching shoulder to shoulder, only a few people go, did you see that? I saw that. Then those conversations, the meta conversations, the meta text after the performance, where people are debating and negotiating and trying to decide all the hidden meanings, it's just chef's kiss.
Yeah,
so
and somebody like me who wouldn't have necessarily watched it and known it right off the bat, but it makes me want to know those things and learn about them and figure out what all the Easter eggs were. So
1000%. This is the power of cultural discourse, that it invites people in who want to know and make people who do know feel like they're already in the end circle.
Marcus, great to see you. Thank you so much.
Always a pleasure. Thanks for having me.
Take care. Coming up, we're live at the NASDAQ with top analyst calls of the day. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tamama, live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. Today we're watching shares of Robinhood, Medtronic, and Microsoft. First up, let's take a closer look at Robinhood. Wolf upgraded the stock to outperform from pure perform. The firm said while declining cryptocurrency volumes should be a headwind to earnings in the fourth quarter report, it sees upside for the quarter given the positive response to prediction markets that Robinhood has gotten. The street is mostly bullish on the stock with 24 buys, 4 holds, and 1 sell. Next up, Medtronic. Needham upgraded the medical device maker to buy from hold. The firm said the company is in the early stages of several major product launches in multi-billion-dollar markets. It expects this to drive faster revenue growth. The street, though, somewhat mixed on this one with 18 buys, 13 holds, and no sells. Lastly, let's take a look at Microsoft because Melius Research downgraded the stock to hold from buy. The firm said it is, quote, even more concerned that the company is moving too slowly when it comes to its AI product, Copilot, in its Microsoft 365 offering. The analyst also said Copilot should be included for free as opposed to an extra cost for consumers. The street, though, quite bullish on Microsoft stock with 68 buys, 3 holds, and no sells. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout today's trading session.
Buy now, pay later platform Affirm points to a healthy consumer as it delivers a sales beat for the second quarter and 23% active consumer growth. Yahoo Finance executive editor Brian Sozzi spoke with Affirm CEO Max Levchin to talk more about the quarter.
Max, good to see you. You had a lot of stuff going on this quarter. New partnerships, new deals. What worked really well for the company?
Without false sense of modesty, everything. I think we had a killer quarter. It's a 5th out of 5 in a row where we exceeded expectations set upon us by the street and ourselves, and so we're feeling very good about the results. Growth was super strong, 36% year over year. Just volume of our merchants, new record highs in revenue. First quarter of $1 billion plus in revenue. Highest number of active merchants, grew 42% year over year. I think it's a maybe singular record of that type of growth. Consumers at 26 million. So every single operating metric of the company is just really, really good.
You and I have talked a lot, and really there's been, especially over the past year, there's just been, seems like this upswing in your business. Like everything that you've been working so hard on has started to click. As you digest, as you look at the numbers in your business, is there one area in particular that is working really, really well right now?
Again, it's hard to separate a thing without feeling like you're besmirching some other metric that's just, every one of them has done really well. I would say the card that we launched a couple of years ago, for a time, people are writing, they talk about the card, but will this thing ever really grow? It is undoubtedly a huge part of the growth. If you look at just the sheer shape of the curve of card actives and volume on the card, it's bending up in an exponential fashion. It's growing 5 times faster than the rest of the business. It's now really hitting its stride. It's north of 3.5 million active cardholders in the quarter. So we're doing really, really well with that product. But again, it's a little bit unfair to single the card out, given we just announced a whole slew of really strong new partnerships. We are heading into helping services that are on QuickBooks Finance, or helping their customers finance various service orders. It's a bunch of initiatives we're doing in helping merchants promote their sales. We had the Big Nothing, the 0% APR days in October. We had a huge Black Friday, Cyber Monday period. So just every part of the business is really firing all pistons. And I think, for lack of a better explanation, the team has been just getting better and better at executing. And, as a business that's still very high growth, but maturing, it's kind of a pleasure to see.
I still remember when you launched the cards, not to date ourselves, but time moves fast in these fields. What's next on the card front for you?
There's a lot. We think there's opportunity to bring even more of the thing that we're famous for. At this point, something like 39% of our transactions are interest-free because the merchants are subsidizing them. The best promotional tool, I'm biased, but it really is true, is to just offer consumers 0% loans. We're bringing more and more of that onto the card. We're offering some special card-specific things, so you can find them in our app all the time. We're going to do more events that are card-focused, just bringing more and more value to our consumers so that our merchant partners can have more sales. That's sort of the main thrust of the card. But over time, we expect to launch some new things. I've also learned the hard way not to pre-announce. To date ourselves even more, I announced the card about a year before we were able to roll out the first version. And for a year, I was getting maligned by various members of the press, definitely not you, how this card will never happen. So I'm a lot more careful now about saying when things will ship. But the roadmap for every part of Affirm, certainly the card, is long and exciting.
Yeah, no, definitely not me, Max. I mean, come on, man. Come on, give me a break here.
You've been a great supporter.
So you have to have. I mean, I always view Affirm as a great read on the economy, and I looked at these results, and I have to think, so many stories that we hear about consumers still having problems with affordability. They can't put an extra thing of Tide in their baskets. Like, you are capturing this. I mean, do you still see consumers struggling to make ends meet at the end of the month?
We do not. If you look at our results, it shows that there's tremendous shopping, tremendous demand for our services. And if you look at the repayment curves, they're still going very solid. And like one of the better sort of measures of how consumers are feeling about their finances after they made a transaction with Affirm, if you go to our shareholder letter, we always publish vintage curves of our net adjusted charge-offs, which is kind of the best metric of like what happens in the end. Did you pay your bill, or did you say, sorry, I'm just going to default in this loan? And they are tightly packed curves, one on top of the other, suggesting that consumers are performing financially about as they have been for the last 5, 6, 8 quarters. So I think the news of the American demise are greatly exaggerated, if we're honest here. We don't say yes to everybody. Obviously, we're very good at underwriting. That's kind of the key secret sauce here is we are excellent at AI. We build our own models. We've always built our own models. So I'm sure I have a slightly biased view, but the Affirm consumer is healthy.
You are my go-to for all things forward-looking software. I wasn't going to say earnings there, Max. Don't worry. But forward-looking thoughts on software, Max. Just given, of course, your experience with PayPal, building Affirm. This is one heck of a moment in software where like companies that are reporting good earnings are getting slammed out of fears that Anthropic or Google are going to come out with some model update that ruins companies that are posting billions in dollars of sales overnight. What is your assessment of what's happening here?
If I could see the future, I'd probably trade the stock market instead of running a company. Not kidding. I would never do anything else. I love starting and running companies, but super sort of a hot take. I think if you're in a business of generating assets, you're going to be just fine. I guess it's very competitive. It's always competitive in every industry. Financial services, no exception. But Affirm makes assets. Our assets look like loans. They are things that yield cash flow. We have a huge partner ecosystem that fund these assets, that buy these assets, that help us package them. We have literally hundreds of thousands plus partnerships with merchants that require both software integration, which is becoming cheaper and easier and better, but also complex business integration, which is helped by AI, but is certainly not a thing that you can completely outsource just yet and maybe never. And most importantly, we have a deep relationship with our consumers. 96% of all transactions come from existing consumers. And the loyalty that we've built, the brand that we've created, is a really powerful defensive mode. So if your business is just building software and you don't have a brand, you don't have a great reason to hang on to your consumers or your customers, other than it's always been there, this is the wake-up moment, because that's going to be very, very tough to defend. Our defensive moat is the relationship we have with consumers, the relationships we have with merchants, the super deep capital markets relationships that we've built over the years, and the fact that we build amazing software and amazing underwriting models, but also the fact that we put our own money to work every single second. There's 40 plus million loans every quarter. Each one of those is a test, not just of our software, but the end-to-end processes. And so we feel very, very good about the value we're creating for the ecosystem, and it will remain competitive, but better AI just allows us to build more products, more features faster. Part of why I'm so excited about the card features, a little bit giddy with how much faster we'll be able to ship all this stuff. So in that sense, it's the best time to be a software engineer.
Max, lastly, I'm just letting it sling. It's a Friday. It's been a long week. My week started with the news out of PayPal. I'm sure you saw one CEO left, another CEO in. You are viewed as the co-founder of PayPal. And my question to you is this: Can that company be saved? The Affirm's market cap and PayPal's market cap aren't exactly that far apart. Is their time just passed and they just can't pull themselves out of the hole that they're in?
I think you're asking me to compare which of my babies I like more. I think that's a rough call to make. Obviously, it is my first baby. I don't love what's happened to it in the stock market. I do think it's a great brand. I think we built something really important and lasting, and I certainly hope it has more moments in the sunshine. That said, we compete with PayPal every single day, and I don't mind having the competition being a little bit easier as far as my current baby is concerned. So I guess to answer your question, on one hand, or nostalgically, sure would be nice. In practice, I'm out to win this market, and they're a competitor. So bummer, but we're on it.
I needed this conversation to end my week. Max, always nice to see you. Affirm CEO and founder Max Levchin, always making time for me and Yahoo Finance. I appreciate it. Congrats on this quarter. We'll talk to you soon.
Thank you.
Coming up, the state of the healthcare industry and some of the changes that we have seen this year, what they mean for you. We'll speak to one of the brains behind Obamacare next. U.S. healthcare stocks have been under pressure this month after the Trump administration announced plans to reduce federal funding for health insurers. This prompted a $100 billion sell-off in healthcare providers, while also bringing into focus wider issues across the sector, with customers caught in the crosshairs of policy, higher medical costs, and perhaps worsening quality of care. So let me bring in an authority on this topic. That's Jonathan Gruber. He's chairman of the economics department at MIT and was a key architect of the Affordable Care Act. Thank you so much for being here. We appreciate it.
Good to be here.
So I think what we're all trying to puzzle out is, amidst all of these changes to healthcare, whether it's the expiration of the subsidies for ACA plans, to changes to, or I guess less than expected increases in Medicare reimbursement, I think people are sort of grappling with what this means to them and their healthcare. Any kind of like big picture takeaways on that front?
Sure. I think the big picture takeaway is, for most Americans, the effects are not immediate. The two groups that really need to be paying attention are, one, those who are buying insurance through the exchanges, who will see large increases, on average about $1,000 a year, in what they pay for health insurance. We're already seeing more than 1 million people leaving the health insurance exchanges as a result of this price shock. Particularly concerned should be those who are older and in expensive states, who suffer from this cliff where once their income's above a certain level, they get no more subsidies. So that's one group. The other group is seniors and Medicare Advantage. Look, it's well known that Medicare Advantage is overpaid. Medicare Advantage companies, I'm sure, won't agree, but it's basically well known they're overpaid. The government wants to try to rein that in, rightly. But what's happened in the past, whenever the government's tried to rein in Medicare Advantage, is some Medicare Advantage plans exit, seniors yell, and the government caves. So the interesting question will be, what happens this time? Will the government really stick to its guns and lower MA reimbursement, even though some plans may exit? We'll have to see about that.
Do you think that what's being done is the best way to address that overpaying situation?
No, I think the best way to address the overpaying situation is to, ironically, do what I think our classic Republican would call for, which is have a real competitive exchange where people choose plans, and where plans have to compete to offer the lowest prices to get to consumers, so they're no longer overpaid, rather than this sort of broken government reimbursement plan, which is largely driven by political decisions on what the base payment should be.
Those people who have been on ACA plans who may exit because of not getting the subsidies, what do? Do they just not have insurance? And then what are then the alternatives that they have, if any?
Look, I think there's really two groups to worry about. One group is those who are relatively low income, too rich to qualify for Medicaid. Those people are going from a zero premium to a modest premium. For those people, I would urge them to continue to pay. It's a shock. People don't like paying something rather than nothing, but it's still a good deal. Unfortunately, the literature suggests they won't continue to pay, that people will drop when it goes above zero. But I think for those folks, the answer is pretty clear. They should just pay. It's still a good deal. I think the more challenging is people who are higher income, where costs are going up. In particular, I've got buddies who are 60 years old in Massachusetts. Their premium is going from like $8,000 a year to $25,000 a year. Does it really make sense for them to still buy insurance? It's not entirely clear, but there's no real alternative. Those are the folks that I think we're really going to be hearing from.
Something separate but related I wanted to ask you about is, we see a lot of the health insurance companies, their medical loss ratios are suffering, the amount of premiums that they pay out to cover healthcare. So in other words, healthcare costs are going higher. And this is something we talked to one of our frequent guests, a healthcare equity strategist, Jared Holtz over at Mizuho, about. And I want to play for you what he had to say he thinks the effect will be.
So I think a lot of the patients on United plans or otherwise are going to see, because of what's going on in the industry, they're going to be paying the same but getting less. I think that maybe from a societal standpoint, the most problematic piece of all of this is that you're going to see patients that pay X but get way less than they used to in the past.
So, Jonathan, do you agree that we'll see some of even the employer-sponsored plans sort of price remain the same, benefits go down, and then what's the ripple effect of that?
Yeah, I think you have to distinguish employer-sponsored plan and Medicare Advantage. For employer-sponsored plan, I don't necessarily agree. I think we have seen benefits haven't changed that much. Okay, what we've seen is a rise in deductibles and a move to narrow networks. Those have largely, I think, played out. There's not a lot more room, and I think that's why healthcare costs are rising. We've seen over the past 15 years is trying to squeeze as much out of the system by narrowing networks and raising patient cost sharing. But I think those have largely tapped out. I think at this point, costs are just going to rise. Now, for Medicare Advantage, on the other hand, I think there could be a reduction in benefits, and that's not necessarily a bad thing. Medicare Advantage is essentially overpaid by the government. They use some of that overpayment to provide benefits that aren't necessarily highly valued by seniors. And I think a better world will be one where seniors could actually have the choice of a cheap plan that didn't have a bunch of extras they don't want, and a more expensive plan that might have extras that they want.
But then will that also mean that unhealthier seniors, that the cost burden is much higher for them?
You know, largely what these extra benefits are not really about cost burdens. They're vision coverage, they're gym membership, they're things which are not really first order in terms of cost sharing. I think there will be some increase in cost sharing, but I think that won't be the first order change.
And just quickly, Jonathan, what do you think is sort of the most acute, of all the things that we've talked about, or maybe not something on the list, what do you think is the most acute problem facing the healthcare system going forward?
I think, as always, it's useful to think about this in terms of coverage and costs. In terms of coverage, the most acute problem is the expiration of the subsidies. And I think ultimately as many as 4 million people lose health insurance. What's going to happen to them? In terms of costs, I think it's honestly something we're not talking about, which is we are in the midst of a revolution of highly effective and highly expensive new genetic drug treatments, and just general drug treatments, including genetic drug treatments. GLP-1s are the tip of the iceberg. Insurance companies are going to face some very difficult decisions about drugs which are really miraculous, doing incredible things, but are also very expensive.
Right, although they'll hopefully save some costs on the flip side and fewer health problems, comorbidities, et cetera. Hopefully, Jonathan. Thanks so much for being here. Really appreciate it.
My pleasure.
That's it for Market Catalyst. I'm Julie Hyman. Thank you for watching. More Yahoo Finance coming up.